My name's Ilan Gur. I actually graduated from here with a PhD in materials science. About halfway through my PhD, I realized that the first paragraph of the science papers we were writing that said, hey, this technology is going to change the world for X, Y, and Z reasons, realized that was just total nonsense, and we had no idea whether the technology would change the world because we knew nothing about how the world actually worked in industry. We were basically working on the completely wrong problems, and so had the distinct pleasure of throwing out all the PhD research I had done to date and restarting. Ended up building a technology that we spun out into a company in the solar material space. It was a company called Selexant, which was backed by sort of traditional venture capitalists. Oh, sorry, yeah. How's this? Can you hear me? So ended up starting a company out of my PhD research and then having a chance to be involved in launching one of the first battery companies in Silicon Valley, battery materials company called CO, which I ran for a few years with my co-founders, only to start scratching my head wondering if the kind of Silicon Valley venture capital model really made sense for hard materials, chemistry, hardware, energy companies. There seemed to be some things that didn't feel right there. Had a chance to go be one of the first program directors at ARPA-E, which is kind of the Department of Energy's sort of innovation funding agency. Did that for a few years and then took all of my frustrations from life in research, startups, and then funding startups and big companies doing research. Took all those frustrations and packaged them into something called Cyclotron Road, which is essentially a cross between a very aggressive applied R&D program and a very early stage startup incubator specifically focused on hard energy technologies. And I'll talk a little bit more about it later.
Great, thanks. Cool. So my name's Peter Secor. I also graduated from UC Berkeley in applied math. And so I was hanging out in Evans for a long time. And I did, yeah, it was fun. And did a lot of software startups and enterprise-focused hardware companies. And so it was usually a combination of software and hardware. I tended to concentrate a little bit more on the software, so it was hardware-enabled software solutions. It was all enterprise-based, usually industry-specific, so it might be in security, it might be in mining, it might be in machine monitoring on shop floors, stuff like that. And built and sold a few different companies, so there was a lot of mistakes. Most of what I'll talk about are what not to do, things not to do. There are a lot of mistakes that you can make. You all think you're very special, and I'm sure you are. I thought I was special as well, but you often make the same mistakes over and over. And so there's certain mistakes that you should make, but there's a lot of things that you can just do what other people did, and that's fine for right now. Then you can become more special later, or leverage the thing that you're actually special for.
Make new mistakes.
Yeah, make new mistakes.
Right.
But so built and sold a couple of different software companies, and grew them through sort of through the different stages of fundraising, IPO, et cetera. And then more recently have been doing a lot of investing and advisory work. So I do investing on the Series A and seed level. So like 500K is around seed, maybe a little bit more, a little bit less, and then sort of 1 to 3 million on the Series A level. And those are kind of where we are. My partner and I did a lot of angel placements and still do that for smaller, either people that go into incubators or that are just sort of starting up and trying to figure out how to get an idea and test it against the market. Most of what we do is technology-enabled software solutions, meaning there's some hard, either science or computer science or algorithmic or physics, or there's some hard problem that somebody solved, but they have to combine that with a couple other things to actually create a business, and we try to help them do that.
And you didn't say the name of your firm.
Oh, yeah, sorry. It's the little fund that we run. It's called Three Bridges Ventures Partners.
I did leave out the fact that I'm also a UC Berkeley grad. I wasn't as smart as these guys or you. I was in a softer science called political science long ago, but I made my way into science. Anyway, so left and started a company called Harvest Power back in 2008. Harvest took, and still does take, organic waste, creates methane gas and electricity, from anaerobic digestion, and they make soil products. So that company did well, grew. I'm going to talk a lot about the financings that we did, we did. We raised about $300 million over 4 years. I left. I was an entrepreneur in residence at Kleiner Perkins, the venture firm, for a little while, and then joined General Fusion as CEO about 3 years ago. So that's my own little story. Not totally related to fundraising, I wanted to spend just like 5 minutes or less on General Fusion, given this is a nuclear conference or boot camp. Though I would say, as we were talking about at lunch, in our marketing materials and as we talk about ourselves, we never use the word nuclear. We actually just call ourselves fusion energy, because there's so much baggage that comes along with saying nuclear, most of which is not valid, but we talk a lot about fusion energy, and that's what I'll do today. Obviously, the big benefits to fusion are probably well known to you all. The amount of hydrogen, if you put hydrogen in this room, this would fuel the entire Bay Area for multiple years, right? The incredible energy density, which makes it, makes it possible to really provide fuel for all of humanity forever if we could figure out how to do fusion. Second, the only emissions are neutrons and fast-moving neutrons, which you can use for heat, and helium. So no long-lived radioactive waste, no fuel rods, no meltdown possibilities. So totally safe and clean. So it checks all the boxes. I talked about energy density. 1 kilogram of fusion fuel, hydrogen in our case, is equivalent to 10 million kilograms of coal. So it's got, it is the holy grail of clean energy. Problem is, it's been incredibly hard to do and remains so. I think there's a whole lot of progress being made in the industry, which I'll talk about, but and kind of where we're at. So as a company, we're a private company. We've raised about $110 million or so. About 80% of that has been private companies or venture capital firms. And about 20% has been from the Canadian government. We're based in Vancouver. So just to give you a sense of kind of the different types of investors that are out there and who invest at different stages, we'll jump around a little bit, but some of the first investors were early stage venture firms, Chrysalix and Braemar and BDC. These are traditional venture capital firms, invested $3 to $7 million. Following that, Jeff Bezos and Bezos Expeditions invested along with Cenovus. Cenovus is an oil and gas company, or a kind of a strategic for us. Not a lot of venture experience, but invested in us as potentially a way to make inexpensive heat for their enhanced oil recovery, and also as an insurance policy. And then most recently last year, the Sovereign Wealth Fund of Malaysia, that's Khazanah, invested last year and led our last round, which I would call Series C. So last year we raised about $40-ish million. So it's a really wide range, and I think the key thing I would get across is that each round, you want all your current investors to invest, and then you want to bring in someone new to lead the round, set the valuation, et cetera. And we're continuing down that track, and as I said this morning, the fundraising never stops, despite the fact we've got a couple years of money in the bank. That doesn't mean we're going to stop. The other thing that I pushed on this morning was about open innovation and collaboration, and just not trying to protect your idea, keep it safe, don't tell anyone. The opposite is true. The world has fundamentally changed in the last 10 years, and getting other people involved in your problem as a consultant, as just someone to help, an employee, a partner, whatever. We're trying to do that in spades. We have partnerships up here. I talked about with Los Alamos, Princeton, and others. Some of the more interesting ones I talked about this morning. We've done 4 crowdsourced solutions. A couple were mechanical engineering. A couple were big data problems that we had. And I think it's sort of bearing fruit, builds goodwill for the company, but also provides a lot of information for the company. I won't get into lots of detail, but just conceptually, how does our concept work? We create a plasma about 4 million degrees. It's in a shape like a donut, like most people in fusion. It is self-sustaining for about 2 milliseconds, which is a long time these days. And we hold that together. It's held together by its own magnetic field for, again, about 2 milliseconds. We inject it, that's a little cone thing where that yellow is representing the plasma there at the top. We inject that through the cone at the top into a 3-meter sphere. That 3-meter sphere is filled with liquid lead lithium, which is spinning in a vortex, kind of like if you pulled the drain out of your sink, there's a little vortex. So there's an evacuated gap or vortex in there. We drop the plasma in, fire the pistons, which creates a shock wave, travels through that liquid lead, and then compresses the plasma from about 40 centimeters to 4. So most of the fusion happens at the end, and the temperature goes from about 4 million degrees where it starts to about 100 million. We haven't reached those temperatures yet, but that's the plan. And then as the fusion neutrons are emitted, they are thermalized by the lead. Lead heats up, pump out the lead, make steam, make electricity. That part's easy. But back to financing your startup. And I heard at lunchtime about the 5 different concepts that you guys have, and it was pretty compelling. Look forward to talking to you guys a lot more about that. So what I was going to do was just sort of set the stage for what these guys are going to talk about, which is kind of what's the life cycle, and kind of how to, where to participate, what matters in that life cycle of fundraising. So I think of it being a spectrum that looks like this. Can start with friends and family as a way to start. If it's 50,000, 100,000, 10,000, incubators, which we talked about in the last session. I think a new concept, crowdfunding, is becoming more and more viable, certainly for a certain subset of product-oriented gadgets and so forth. It's pretty compelling. Then seed funds, like what both of these guys have, and government grants, how they fit in, and then moving into Series A, which can be, I think, anywhere from $1 million to 20 million, depending, and then Series B and C. So kind of that's how I think about the spectrum. I was just going to give you my own 3 startups and kind of what they look like, just to give you a sense of, you don't have to follow a path exactly. This is just the spectrum as it exists today. So my very first startup was an internet bubble company, started in 1999, which grew really fast and then shrank even faster. It was an online legal site. We started in 98 maybe. And little friends and family money, got it going. Within a couple months, raised some venture money, raised about $4 million. Built a team of about 30, kind of executed strategically pretty well. Raised another $5 million to kind of keep it going. And then long before your time, the NASDAQ crashed and no more funding was available. And we weren't profitable. We existed for a little longer and then closed up shop. But as Peter was saying, it was lots of great lessons were learned in that process. And then General Fusion, its history, so I've been there for 3 years, so some of these financings took place before me. There was a friends and family round about 2007, which was about 750,000. Lots of small investors. It was about 30 people all putting in smaller amounts of money. And then in 2009, a $1.5 million kind of seed financing from a local firm in Vancouver called Chrysalix. Along the way, not just at that time, but along the way, we've gotten about 20 million in government grants, all Canadian. And then Series A, that was a combination of the other venture firms I mentioned, Braemar, BDC, and then Jeff Bezos joined. And then Series B and C have been over the last year and a half, 2 years, and that's totaled 65 million. So it's been this sort of growth and spectrum over time. I put it next because the money was larger. So Harvest, which was my previous company, there was friends and family, but most of that was, how do I say, sort of our own sweat equity and our time that we put into it, which turned into dollars. We really went straight to Series A and raised an $8 million round when there was about 4 of us and a business plan. It was a little easier to raise money for hardware stuff in 2008 and 9 than it is today. And then we really just kind of kept the gas pedal down on fundraising. So I think we closed in that $8 million in May, and then did a $30 million round in December. And then a year later did a $75 million round, and then another year later we did a $125 million round. So the goal there was to just keep the pedal to the metal. We were focused on growth. We were not focused on profitability. We were focused on traction, market share. This again was a company that's sort of the waste to energy company. So our goal was to get local market share in all the markets that we participated in, acquisitions, build energy projects. And so we didn't. What can I say about that? The goal was growth. It was not as much profitability. As we matured, starting in about 2012 and 13, we started to focus more on profitability, and that's kind of where the company is today. Just as another kind of version of how you can fund. I tried to come up with one that was totally different. Pebble, I don't know, does anyone have a Pebble watch? It's amazing because Pebble watches raise all this money and gets all this, but I've never met anyone that actually has a Pebble watch. So they did friends and family round of like 400,000. They did go through an incubator. I think it was Y Combinator, about 50,000, and then they did a big crowdfunding on Kickstarter, which I think remains the biggest crowdfunding dollar amount. I think it was about a little over $10 million. After they did that, they actually did a venture round of 15. So we're really able to use crowdfunding as both a marketing vehicle and as a source of capital. And then lastly, because it's just so compelling, Pokemon Go. Pokemon Go was seeded inside of Google. I've become intimately familiar with it. I have 3 kids who spend the majority of their day playing Pokemon Go. So seeded inside of Google, and then this is Niantic I'm talking about, and then went straight to a strategic round of $30 million. So as you can see, there's not necessarily a perfect pattern to how money gets raised. The lessons would be pick your investor, wisely, and raise a little more capital than you need at each stage. I will spend a little time on this, but I think this is going to be a great segue to the other panelists. So what I was going to talk about is at different stages, what do different investors tend to care about? And I kind of put some items on the left there: the quality of the team, the differentiation of the product, size of the market, capital intensity, et cetera. So I think early on, and even all the way through, the quality of the team and how differentiated the product or solution is are top of the list. I think the size of the market, everyone says, oh, the size of the market's really, really important. I think the size of the market and your entrance into the market starts to become more and more important as you get a little later. Ditto for capital intensity. I think that's one of the challenges that in hardware is the capital intensity piece of our stories. It becomes more and more important later. And then I think toward the end in the Series A, which Peter will talk about, traction with customers. Do customers care about your product? Is anyone buying it? What do they say about it? Becomes more and more important. So just sort of pointing that out, because you can't solve every problem in the first 6 months.
I'm no lawyer, right? But a company is sort of right? Once you talk about a company, you're talking about a structure, a legal structure. And in particular, it's a legal structure that essentially lets you bring together shareholders and investors towards some mission. But fundamentally, the goal, first principles of a company is to create value, right? And specifically to create value for its shareholders, right? Normally those shareholders, hopefully include to a large extent you as the founders, right? But a large degree of those shareholders will end up being investors, whether it's your venture investors that Nathan's talking about, or public sector investors on the marketplace. So again, sort of back to first principles, creating value for shareholders. How do you create value for shareholders? Someone before said making money. How do you make money in a company?
Sell stuff.
Sell stuff, right? So let's think about what it means to sell stuff. And when I think about first principles around that, I actually think about what you're trying to do. You can actually think about it as a chemical reaction, right? This is a nice way to think about it, right? Which is, in a chemical reaction, you're trying to go from some reactants to some products. Let's think about this in your company, which is you're trying to go from something you're going to build to actually someone selling it, right? And there's thermodynamics, which is delta G, right? Which is basically, does that want to happen, right? Is that a spontaneous reaction, right? That's essentially the value proposition. You guys have been talking about some of this, right? Value proposition is like, does anyone want the shit you're making? Seems pretty reasonable, right? And if it's exothermic, meaning yes, they want it, then in principle, it's worth something for them and they'll pay you money. That's your energy, that's your free energy, right? The more exothermic it is, in principle, the more money they'll pay you, right? Makes sense, right? But that's only half of the story, which is you've got kinetics, right? So even if there's a value proposition, even if someone wants to buy something, that doesn't mean you can actually make money in your company and create value for your shareholders, right? because there needs to be a mechanism by which that sale happens and the money gets from you to there, and it's got to happen at a certain time frame, etc. And so we can think of these principles through actually the counterexamples of what happens if you create a company where the thermodynamics are wrong, right? So the example I have, and these might be controversial, right? But the Segway, great product, seems awesome. Wait a second, people don't care as much as we thought, right? The kinetics are actually pretty easy. I've set up a website saying I'm selling Segways. Like, you push a button and you get a Segway, and you transfer the money into my bank account as the company. Like, there's no issue there, right, in terms of the kinetics, but no one wants it, right? So delta G was sort of the problem there, the thermodynamics. It turns out it's actually pretty darn hard, and harder than you would think to test. Does someone actually want what you have, and how much are they going to pay? In energy, one of the issues we have is sometimes the value proposition is not as strong as we'd like, largely because if what I'm promising you is to deliver you electricity from a solar cell versus the grid, right? How does that change your life? How much are you actually willing to pay for that, right? The delta G is not actually that strong because you probably don't even know how much you're paying for electricity, right? So there's a question of, is this strong enough? The kinetics are harder, right? And oftentimes you've got a great idea where it's clear there's a lot of value, and it just turns out you can't build a business around it. So this is a company and a product you probably haven't heard of, although I'm sure Nathan has. There was a company that was created, it was based in Marin, it still exists, I'm guessing, called PAX Scientific. The inventor of PAX had this phenomenal realization that there are these amazing shapes in nature that are very, very efficient shapes for fluid dynamics. And you'd think someone had heard about this before, but it turned out he was an inventor, tinkerer, and he ended up doing the first experiments by actually flushing his toilet and finding a way to, do you know this story?
No.
Finding a way to like freeze the tornado shape, right? Freeze the vortex shape in the toilet. And then he built a mold out of that and created a fan. And when they did the tests, it turns out the theory wasn't even there yet, but when they did the tests on this fan, they found out it could move about 40% more capacity of fluid at the same energy, or the same capacity at 40% less energy. And by the way, if it's that much more efficient, you've got less mechanical stresses on the fixture, and so you potentially have a much longer life of the part. Like, this is all great. And you go and you talk to people, and you say, would you like to pay, you know, Nathan, right? Like, would you like to pay 40% less energy for your air handling in your house or your company or whatever else? And he says, absolutely. And what they basically found out was that's great, except for the fact that the people who generally use air handlers and pay for electricity are not normally the people who are buying the equipment that gets installed in a building, right? Two separate people, right? And the people who are buying and installing the equipment, what do they care about? They care about selling you a house or a building and making sure nothing breaks. So they have no incentive, because they're not paying the energy bills anyway, to change, right? And so they built this product which had enormous value in terms of thermodynamics, and there was no way to sell it to anyone, right? And then you can think about new business models, and there's a big story there, but it gives you an example of where sometimes the kinetics in the business model get stuck. So to some of the stuff that Peter was talking about, right? How do you test the first principles of your idea? Okay, so if I were to tell you, hey, you're going to go into the lab and do an experiment, right? And you're going to test a reaction, right? You'd probably want to say, well, let me look into some of the thermo. Let me look into some books and figure out like whether this is going to work before I spend a day, a week, a month, you know, doing the experiment, right? So how do you do that in a startup? Well, it turns out if you're in software, right, it's pretty easy to test, right? Both the value proposition and the business model, and this is what Peter was talking about. You put up a website, you put a buy button, you don't even have to have made the product yet. You have some mock-up, etc., and you see whether people buy it, right? In hard tech, this is a lot harder, right? And it's a lot harder because, and this is kind of a very simple idea, right? But the cost of developing, right, your product, having gone through and figured out what's the value proposition, what's the business model, it's basically a question of the cost of every learning cycle you do times the number of learning cycles you have to do, right? In software, a learning cycle is pretty easy, right? Everyone talks about pivoting, right? Cost of a pivot is pretty low because it might take, you know, another couple weeks to make a new version of that platform on software, and you could very quickly test it with customers again, right? In hardware, you could be talking about, I don't know, Nathan,
Yeah,
right?
we have very expensive cost of learning cycle times very slow learning cycle sometimes. I mean, honestly, that's one of the challenges with fusion and new vision concepts as well. Both of these are a challenge.
Yeah,
Yeah.
right? So if now, right, if every experiment you're going to do all of a sudden costs millions of dollars and not tens of thousands of dollars, and if to figure out the result of that experiment is going to take you 2 years or 18 months instead of weeks, right? What I would argue is, if you think about this experiment analogy, you're probably better off trying to really figure out some of the principles of that experiment before you go spend that money and time, right? And this ends up being, these learning cycles end up being important, and the idea that the cost of these things, both in capital and time, is high for hard technology, it comes into play because A, you're going to spend more of your life and more of someone else's money only to realize that this thing might fail, right? That's no fun, right? And there are tons of people who have built startups in the energy space, especially in hardware and materials, that spent a decade of their life and hundreds of millions of someone else's dollars just to realize, oops, that didn't work. Like, that sucks. You don't want to do that. But the other reason this is really significant is in software, to get started, if you think about Nathan's chart of financing vehicles, to get started, all I might need is $50,000, maybe $100,000. I can go to friends and family. I can crowdsource. I can find ways to get that. And then I'm off to the races and I'm now learning. In hardware, in at least this type of hardware, if you need $1 million or $2 million, guess what? The only place you might get that money today is from an institutional investor, right? And this is this is a slide I came up with at some point, which is, if the goal is to create value for shareholders, there's an entire spectrum of ways to do that, right? You can go, develop a little product and sell it at the mall, right? In little stores at the mall. And you can make money doing that, and you can create value for maybe the only shareholders there are you, because you didn't raise any money, right? Or you could go build a big venture capital company to be $1 billion. It turns out, every dollar you take from an investor, it doesn't matter who they are, starts to limit this spectrum in terms of your options of how you build a company. And the best example is institutional or venture capital, because their financing model to be a venture capitalist and make money means they make a lot of bets, and every bet has to be an enormous grand slam success. Meaning, as soon as you take $1 from a VC, the idea that you're going to go set up a shop in your local mall as your business, that's out of the question, right? So if all of a sudden you need enough money where you're limited in how you get that financing, you run the risk of basically collapsing the spectrum, right? And building a business that's aligned with this kind of model and business model before you actually know, you haven't done any learning cycles here, right? You haven't even gotten the money to learn, so you don't even know what kind of business it makes sense to build because you don't have any experience, right? So what you found in 10 years ago when a lot of companies were raising venture money was a lot of them took venture capital money, used the first $5 million to actually learn, and then they realized, well, wait a second, I'm not sure I can build a business that satisfies my investors. And then you're in a tough spot. What do you do about this, right? And one option is you just decide, I'm going to start a software business because this gets a lot easier. And that's fine. You should, if you're passionate about that, go start a software business. The other is what Peter said, which is look at the business and the problem you want to solve and figure out, right, what are all the things you can do to reduce the cost of learning, each learning cycle, and reduce the time of each learning cycle or the numbers that you need. And pulling things into software or simulation or having part of your business be software can let you do that. And if you can't do either of those, or if you've exhausted those things, right, then the question is, what do you do? And I would say what you do is try to do some of this learning and some of this preparation and thinking about the first principles before you've even started, right? Before you've gone out and raised money and you're on this company conveyor belt. One way to do that is just if you're in a university, right, if you're halfway through your PhD, use the second half of your PhD to start testing value proposition and talking to customers and thinking about the software side and talking to investors, right? Use that time to get smarter about what you're building and why. The other option is we've built this thing called Cyclotron Road. So I'll tell you about Cyclotron Road, which is basically built to try and help with this problem. What we saw over the last 5 years or so was that folks who wanted to build new companies in energy, the software folks were still very excited and off to the races. The materials, chemistry, kind of hard technology folks were saying, I'm not really sure how to get started. And we realized there was a pretty strong need for the best of those people. So the model we built was one, let's find the best of those people. We run a really selective competition once a year. We're going to be launching the next competition this fall, where we say, if you're a hard tech entrepreneur founder, and you've got an idea, and you need to figure out these first principles, you're not ready to go raise the $5 million or the $2 million yet, come into our program. In the last 2 years, we've selected 6 either founders or co-founder teams. And what we do is we basically give you access to a world-class research lab, right? One of the reasons hard tech folks need more money to get started and have longer cycles is because you need to build facilities and you need equipment. So we, by running this program out of Berkeley Lab, which if you don't know is about $1 billion a year research facility, we actually take the people in our program, we bring them in and we give them that world-class research lab as essentially their early test kitchen. What that means is instead of taking a year to go raise money and then another 6 months to set up a lab just to start getting learning cycles, you come in and from day one you're actually starting to learn. You're maturing your technology, you're understanding about the technology risks, but you're also spending most of your time thinking about these sort of thermodynamics and kinetics of what a business could look like. With the goal being that through having great facilities and having that seed experience, you can now get the right types of funding at the right time. So the teams that are in our program, we work a lot with to get government funding, which still keeps that spectrum really open. And then we're working to basically position folks to think about, okay, are you looking for a traditional venture capital? Do you have a story that makes sense for that type of funder? If so, we'll introduce you to the best of those, and hopefully you'll do well on that path because you've thought through it. But maybe what you're doing is not right for a Kleiner Perkins, but maybe it is right for a special strategic fund of Incutel that does stuff, funding for the CIA, right? Or a family office, or even a philanthropy funder that cares about nuclear. Or maybe what you have is not a standalone business, right? Maybe what you have is something that actually the best way to get it out to the market is just to team up with a big corporation and have them license it or acquire it. So that's the basic idea of what we're doing. And that's it. Cyclotronroad.org, check out the website.
And when's your new cohort, when do people apply for the next one?
So we will probably announce the new competition right around October 1st. And the idea would be that you apply over the fall, we select people beginning of the new year, and then you're in as soon as you can get here. So yeah, happy to talk more about it.
Yeah,
cool. Really simply, I want to test all these things against all these things. That sounds fine until you realize, well, what if there's 1 million things up here, and and there's 100 million things down here. Suddenly this matrix becomes kind of untenable. Except if you can simulate or emulate the chemical reactions reasonably. I'm not saying perfectly, you just have to be pretty close, because what I'm about to say is I don't want to solve the problem. I want to show which ones of these, don't work. Because probably most of them aren't going to work. So if I can throw all this at Amazon Web Services or a similar cloud service, which is totally possible now, I can write software to deploy it at scale. I can actually, from a computational point of view, I can narrow this down from 1 million by 100 million matrix. I'll find, only a few thousand things that actually might work. I don't know if they do work, but I definitely proved that all of these don't work. Cool, I just limited my problem space. So I've turned kind of a hard sort of lab problem, right? This lab is really big and expensive, to I'm going to go get incubated at Illumina over in South San Francisco, where J&J has an office like the incubator like this, or a bunch of them. And now I just have to have a lab that does a few thousand things or a few hundred things. And even then, there might be other filters that I use to say, I'm going to look at these ones a little bit closer. I have a better model that I'm going to run on those. So I might then be able to get rid of even a few more and take another order of magnitude out. So that's just sort of to add on to what you're talking about. Like, how do you change the problem space into something that you can lever your own experience, but in particular lever the software aspects of it, right? Because those are a lot cheaper to fund and also a lot cheaper to iterate on. And so you don't have to get the science perfect. You want it to be really hard, but you don't have to get it perfect. You just have, when you're doing these negative ones, it's kind of the reverse. You just want to narrow down the problem space. If I step back then to to how you try to raise funds, usually the way that we look at it might be slightly different than other funds. So I'm going to tell you our perspective. There's also this, what people call the spray and pray, which is, you make tons of investments and hope that one of them or two of them hit it really big. You could be more of a private equity type of investor, where you say, I want all of my investments to do really well, and so I'm going to be really picky, but if I choose one, that one's, it better succeed. And then there's some other types of investment philosophies as well. Ours is kind of down a little bit in the middle. We don't expect these bazillion-dollar returns, but at the same time, we want it to be a very solid business. I want people to understand, and these are the milestones. I want people to understand that if you're going, here's what I want, friends and family. This is what I'm trying to prove. I have milestones 1, 2, and 3. And these could be, I want to show that the prototype exists, I've written a model, and it's theoretically possible that this works. I've convinced some people that trust me that they should fund me for a little bit until, and so I can prove that. So, check, I've proved that. Now I go to seed funding. What am I doing here? I'm testing out some hypotheses now. So I've got a few things now. First, maybe I want to see if, maybe I should do the this try out button. I want to go see if there's actually people there. Maybe I'm literally walking to different labs. I don't have to scale this. I'm not trying to scale my business model. I'm just trying to show that I could find value and somebody's willing to give it to me. Because you could have something like the fan, or you could have something that really makes a lot of sense. There are a lot of people that have always tried to do these email inbox organizers, right? Because you get too much spam and too much stuff, and how do I automatically do this? Or these automatic schedulers. Hey, if so-and-so's in town and so-and-so's in town, we should get together because it's value add and we're gonna network. And there's all these businesses that have tried to start. There's a lot of value there, right? People should network. People should do these things. But it's smeared out across lots of parties. Who's going to actually pay for it? Would you? And if the answer is no, that's a little scary. If you wouldn't even pay for it, then But if you can find people that will actually pay for the idea, usually they pay for your time at first, so you can do consulting. By the way, hint, hint, wink, wink, that's a really cheap way of funding your company, is to just consult. And you own the IP, but you start solving the problem. You're not going to get it right first. So accept that, go out and try to solve it. And you can actually get consulting contracts to do this. It's really, really interesting. I want to go out and sell 5 units. It's okay if they cost a big chunk of that, because that's my test. If I can sell those, then I know I can go out and get a contract, manufacturing contract, and take out a lot of costs on that. We did this. We have a electric car charging company, and it's kind of sneaky, because it's not really a car charging company. It's really an outdoor advertising play. And what they said was, hey, we're going to put this really beautifully designed, looks great, really beautifully designed car charger, front and center at high value demographics like Whole Wallet or something like that, big mall. They get the parking space right in the front, paint it green. You tell an awesome story about energy efficiency and electric cars and all kinds of good stuff. And guess what? Actually, what they want is on the other side, not the side that you pull into. Right? You unplug it, stick it in your car, no charge. You don't sign up, nothing. Just plug it in, you're good, and it charges while you're wandering around. On the other side, they've got 2 screens. They do some really nice advertising. They've got cameras. They do analysis of the audience, et cetera. Those are demographics, et cetera, et cetera, et cetera. It's an advertising play, right? And so it's this combination of hardware and advertising. When they first built the hardware, it cost $30,000. And you couldn't make the economics work really well with $30,000. They've now got the manufacturing company. Once they proved the model, though, they proved how much they could sell an ad on the other side of the charging station. Once they proved how valuable that was, then they got funding. They brought the cost down to, I think it's like $5,500 now, and they probably can get it even lower. And so, but but they had to prove that hypothesis first. The hypothesis was, hey, I can put a station here and I can sell ads on the other side. It turns out they couldn't sell, I'm lying a little bit, or I'm being a little bit sneaky. They sold ads, but they didn't sell remnant ads. They didn't sell like, Yahoo or Google or, those types of, they didn't sell those little ads. What they instead did was they sold sponsorships. So a company that wanted to sort of show off its green, its green campaign, or that it was investing in that, they would sponsor all of the charging stations in a particular area. So Chase, for example, had a big campaign around this. Nissan did, and I think I'm forgetting the other one for Tire Rack, which was interesting. But they wanted to show you still need tires even on electric cars, kind of thing. And those sponsors actually drove the business. And what this comes down to is, you want to test these hypotheses, because once you do that, then here is where you start. This is team plus initial scale, and at Series A, then you've already shown that you've shown that there's somebody out there that's willing to buy. You've shown that you have a product totally unoptimized, or maybe you are and you're super cool, but it doesn't matter. You've shown that there's a product market fit, and you have rough models on how much that will cost and how you think you're going to take cost out of that or improve the profit margins. And then here you have bigger hypotheses, so you're still testing out hypotheses here, but here you need a sales process. You might need a manufacturing, other types of things. You haven't scaled these yet, but this is what you want to show. You want to say, look, I'm going to build a sales process that looks kind of like this. It's going to take me, out of the $5 million that I've raised, it's going to take me $1 million to do that. And now here's my manufacturing process, and I think I'm going to take out 50% of the cost, and I've got this other, this other 25% that might come later when I'm going to scale out more. Things like that. And at each of these stages, you have very specific milestones. 7, 8, 9. I usually try to keep that sort of under 5. You have sort of under 5 major milestones. If you hit these milestones, your company is more valuable. So even if there's a downturn in the market, even if something bad happens, even if like green energy is no longer cool, or whatever, Pokemon Go is no longer it's. You might get a little bit of the macro up and down, but if you build an actual business and you show that you're more valuable, you will raise more money. And because that's getting the shareholders more money. And that's what that's what they're interested in. And there might be a mission, et cetera, and that's what they're buying into. But remember, you're trying to show that you're creating value here.
What other ways are there? We can find different ways to reflect and avoid those mistakes.
Elon, you want to take that one?
I think you just boiled down the problem of innovation in areas like nuclear. You're right. You're probably not very easily going to be able to change the regulatory landscape as a single entrepreneur, right? So you're thinking about exactly the right problem, and the question is, well, what are all the ways you could do it? Well, one is, this is sort of binding constraints, right? If the regulation is the constraint that says we're either going to make it very hard for you to run your experiment, or we're going to make it such that if you run one experiment and fail, you're done forever, right? You got to get away from that. So simulation is one way. Another way is look for ways you can test outside of that regulatory sphere.
Yep. And I was going to say, and one of the ideas, maybe I'm off on this, that I was hearing at lunch, one of your ideas was to actually create a regulatory consulting firm to advise other nuclear startups. That's actually an interesting way to de-risk the regulatory side of your own idea, potentially, if you're deriving consulting revenue from helping other people solve regulatory issues. I thought that was kind of novel. Anyway.
And I think the reason I went to the first principle of what does a startup do, create value for shareholders, right? Some people said solve problems, right? Some people said change the world, whatever else. Unless what you want to go do and what you're willing to do is an effort which at the core is about creating value for shareholders, don't start a company, right? Or don't raise money from certain investors, because honestly, there are a lot of ways to change the world, and you can be an entrepreneur without running a company. right? Maybe the way to, right? Maybe what you realize is like to solve this problem, we got to change the regulatory structure. And as an entrepreneur, your goal in life is now to figure out how to change that regulatory structure. And maybe what you're creating is a nonprofit or an advisory firm or something else. It may be a business, it may not. But you kind of got to separate these two things. And right, there are times where those things are magically aligned. Where, when I started my company out of my PhD, every venture capitalist in Silicon Valley wanted to fund an early stage, solar materials or battery materials company because they all thought they could make a ton of money, right? So now you're starting a solar company and, right, you're perfectly aligned with creating value for shareholders. Now a lot of those investors aren't sure they can make money doing that, right? So what do? You have to ask yourself, well, do I believe I can make money? Do I believe I can make the kind of money that those investors want? Because if not, maybe what you're doing is you're starting a company on your solar materials project, but you're not going to raise money. You're going to do all the research out of your university, and you're going to go license it to a big company, and that's going to be your win as an entrepreneur, right? So you got to think through that stuff. But I don't know if there's any other answer to your regulatory question other than get out of that sphere of regulation. And it might mean, we used to think at RPE, I used to think about nuclear, whether RPE should do anything about nuclear. And the question I would ask people who knew that space was like, can you get down to a scale of experimentation, right? Or a product that's at a scale where now the risks are not significant, and you can actually create a product that, powers your cell phone with radioactive materials, because by the way, like, who cares if it goes away? It's not actually going to hurt anyone or create a security risk. Right. I don't know this space, but right, there are different axes.
How are we doing on time, by the way?
We're doing fine. We have like half an hour, so I want to
Okay,
get into
great.
some of the nitty gritty of. So the question for you, Peter, is how do you decide how much money to raise? So
Yeah.
5 ideas out there, all very different. How do you decide how much money to raise? So is it milestone based? Talk
Yep.
about that for a second.
Yeah, and so this is really interesting because the answer will depend upon what you want to do. Nathan, in his earlier slides, you saw those different scenarios, right? Sometimes you are growth oriented, sometimes you're revenue oriented, sometimes you may be like number of clicks or number of downloads or number of users, right? Those might be your metrics of success. So in thinking about that, at each of these stages, I've got these milestones. Are those revenue milestones? They might be, but notice I didn't say they were. I didn't say I was making money there. Those might be number of things installed. They might be, number of devices delivered. It might be revenue generated. It might be something completely different. So you think about what your engagement metrics are and what your success metrics are. And then you measure those and you figure out how will it, let me say it slightly differently. You put into place the mechanisms to measure those. And then you say, if I get there, how much will it cost me? What resources do I need? And then you raise approximately that much money. So how many resources do I need to get to milestones 1, 2, and 3? How, do I need travel budget to go travel to a bunch of places? Do I need to shop the regulatory market? We have one company that it does pharmaceutical. It does an application that allows doctors, patients, and the pharmacies to communicate. It's technically illegal in the US and in Europe because of the regulatory mechanisms. The people doing it think it's going to add a lot of value for all of those parties. It's just you can't do it the way the information is shared. However, in Ghana, totally legal. That happens to be where the entrepreneur is from. They're testing it out there. And he just got a contract in Israel. So they looked at different regulatory regimes and actually shopped for places where they could test it out, see that the value was there, and now they're looking more at the standards, the regulatory regimes, et cetera, and they're trying to get that into bigger markets. But they've involved other people that also benefit. So some of the big pharma companies, now that they see this model working, they want it to work in the US. So now they have a much bigger player on their side, and that's what I'd recommend from a regulatory place is you say, look, if my idea works, it's going to make these 4 companies a lot more money. Let me see if I can get them on board to help me fix these regulations or change them or whatever you need to do.
Yeah, what?
That specific example, I'm not sure if you're aware, we cannot take nuclear material anywhere except in the country, and if you do, it's not even export controls, it's like proliferation resistance.
Yep.
So you could take it to the UK or to China, but then you still have to undergo some process to actually get that permission in that country because you're using nuclear material.
Yep.
So that puts that roadblock in the way, and I think, I've dissed, quote unquote, the regulator quite a lot. I've been quite negative on my thoughts about them in the last couple of weeks, but actually on this side of things, I think they're probably right. So I think that's another, and I'm not trying to be playing devil's advocate, that's another roadblock. So
totally.
In the nuclear industry, that's why we have a bigger problem than with other industries.
To back the picture, well, that was a second caution, on that. Like in the UK, and I think in the US as well, from what I've heard people saying, the regulator's there to protect you and the public. So one of the panels that we had this week, we're talking about, you want to be an entrepreneur, and in our space, work around, fancy work around the regulator. That's not acceptable in our industry because they keep us and the public safe. So I'd be more inclined to go for the idea where you reduce the scale. Some of them do third models, like their prototypes. That's probably more appropriate in our industry, I'd say.
Yeah, and that sounds very reasonable. And because of course I'm not recommending go around the regulators, but sometimes the regulations actually are constraints that you may think are reasonable or unreasonable, and then that's a value decision. And but again, I'm suggesting you look at the problem holistically. Like, what are you actually trying to do? Maybe it totally makes sense that is kind of this really big problem that you need to solve. Cool, then I'd go get other people to help you out, right? To help you maybe adhere to the regulatory regime, right? And so if you've got lots of people adhering to it, they're helping each other out, they're doing it, and you run as part of your business, you have you run a meetup for all of the people who are also entrepreneurs, so they can talk about their experiences, getting through the regulatory hurdles, which you believe in, but are still a pain in the butt to do.
There's I think a universal principle here worth thinking about. There's one of these definitions of an entrepreneur, which is someone who can wield dramatic control over resources that aren't actually under their control. Not saying it exactly right. It's sort of a cliche, right? But it's true, right? Like what entrepreneurs do well, and there's this sense of leverage, is you don't actually control what some big company is going to do with their policy budget. But through a series of conversations, you convince them that if your innovation is successful, they're going to make a ton of money. All of a sudden, their folks in DC who hold a lot of weight with congressional staff, et cetera, are they're telling your story, right? That's one example, right? Another example might be finding ways to leverage existing facilities and resources. You'll be thinking about that, I think, in every part of what you do, and it's especially important. It's especially important when you're an early stage entrepreneur because you don't have any resources. And it's especially important if you're working on a problem that takes enormous amounts of resources to actually move. So something to keep in mind.
And I was going to add, it's interesting because in the nuclear space, we're constantly talking about regulatory as the biggest hurdle, which I think it definitely is. But the interesting thing is maybe that's where the biggest opportunity is, because I know, for example, NRG, when they were looking at building a nuclear plant, they spent $600 million on the initial regulatory and design work of whatever the old school nuclear fission plant that they were going to build. Think about how much money that is. If you can build a business to help the NRG of the future that's going to build that fission plant in the UK or wherever, and you can make it 15% faster or cheaper, you created enormous value, and that customer is going to be willing to pay you. So if that's the pinch point in nuclear fission, well, that's the opportunity, right? If it takes 10 years and $600 million, God, what a great opportunity for someone. Do I necessarily know how to do that? I don't. Maybe it's computer simulation, maybe it's lobbying. I have no idea, but there may be a business there. I was going to say, as an analog from my previous company at Harvest, so our whole idea was make energy. We started out make energy from waste. So we started trying to do that. We'd go to municipalities, say, hey, we've got this awesome technology, you should install it, and we'll make electricity for you. And we realized through that process that one of the biggest kind of barriers to that whole field was there were very few licensed locations where you could take organic waste, and then it took like 10 years to try to get a new site permitted to take organic waste. So that became the pinch point, so the business strategy changed, so we said, we're just gonna go and buy as many licensed organic waste facilities as we can, and just own a market. So we went to Vancouver, for example, bought up basically all of the organic waste facilities in all of Vancouver, and that was kind of how the business got started. So it became we used regulatory as the advantage and as the foundation for really building the business. And then now, even today, it's almost impossible for someone to create an organic waste business in Vancouver because there's nowhere to put anything. So interestingly, you can turn even really horrible, annoying things like regulatory to your advantage if you're just kind of creative about it.
Yeah.
I had a question for both you guys that I think if I were in their shoes, I'd want to know, which is, where do you get started on, who do you talk to? How do you go and actually raise money, right? So say you figured out from your milestones, you need to raise $1 million. Where do you start? Who do you call? Obviously they're going to apply to Cyclotron Road in October, and hopefully they'll all be accepted, but in the off chance that they're not, where do they begin to raise the $1 million?
So I think the easiest way for you guys to understand the answer to this question is flip it and put yourself in the shoes of someone, let's say you made a ton of money or your job is to invest, right? Who are you going to invest in? How are you going to think about who you invest in, right? Well, so you all have science backgrounds, so you're going to do a lot of research on any investment opportunity and do deals, and do diligence and, do R&D research on it before you make an investment. But ultimately, you're going to invest in someone that you trust, right? And so if you now flip back, right, you're an entrepreneur, who are the people that who trust you enough to invest in you? They're generally your friends from college, your friends from high school, your one or two advisors, family members that right? Are they going to give you the money you need to build your company? They might give you a little bit of the early money, but they're not going to give you the money you need to build the company, right? So ultimately, your goal is going to be to find and somehow present yourself as a very credible, trustworthy opportunity to an investor, right? And generally speaking, the best way to do that is to have that investor find you in some way where you're presented with credibility. By far the best way is an introduction, right? So someone who knows you very well and trusts you very well also knows an investor really well and says, Joe or Beth, my friend here is about to throw his life into building an amazing company and opportunity. I think you should look at it, right? The difference between that, no matter how good your research is or your presentation is, the difference between that one sentence of an introduction, it's orders of magnitude more important than whatever your business model is, right? So that's one thing to keep in mind. You might not have the network to find those people, right? If you're playing the long game as an entrepreneur, right, what you're always doing is trying to cultivate trusting relationships with people who have trusting relationships with the people who are going to invest in you, right? So you really have to think strategically about that. That's a long game. But at the very beginning, if you don't have the relationships, the only thing you can do is tout all of your other sources of credibility, right? So if I don't know you, I at least could be encouraged by the fact that, you went to school at a top institution, right? That you have a reference of your former advisor who's a Nobel laureate, so it must be a stand-up person, right? You're affiliated with a top program. It doesn't matter what it is, Y Combinator, Cyclotron Road, et cetera. These sorts of things, this boot camp, these mentorship opportunities that they're giving you, right? Like, why do they do that? Part of it is to give you feedback, but that's not why. It's because it gives you an opportunity to build that first seed of a relationship, right?
Every once in a while I'll get, like a LinkedIn request, not to join somebody's network, but a question, which is, hey, I'm just starting this company. I'd love to get your advice on X, Y, or Z. So like 3 weeks ago, somebody never met the person, emailed me about a drone company that he has. It's a drone thing for construction of projects, monitoring, and et cetera. Never met the guy, and he said, hey, I want to get your advice, who to talk to. Just starting to build the company. We have like 5 people. So because he was asking me for advice,
yeah.
I was actually happy to talk to him. So that there's an expression: ask for advice, get money; ask for money, get advice. I think there's a lot of truth to that. So
even if you don't know the people, you find out who's in the ecosystem that funds this type of thing. You reach out to someone in that ecosystem and say, hey, I'd love to get some advice on the business I'm starting. They'll give you advice. Your hit rate might not be too high. It might, only 1 in 5 people might get back to you. But the person that does is either going to help you with an intro or tell you why your idea has problems or issues, which is good feedback. It's part of your learning iteration. So it's a pretty low friction, easy, low cost way to get feedback and also to get advice.
Yeah, I think going back to sort of how science breeds you in bad ways.
That goes against your nature. Yeah.
Yeah, I think one of the biggest sort of, I won't call them mistakes, but one of the things that early, especially technical entrepreneurs, I think need to work on is you get this idea that like your goal is to go raise money and there's a process for doing that, and you try and think about how do I optimize that process. Almost like how am I going to ace this next test? And it turns out, like the process is important, but people aren't investing in you based on how your PowerPoint slides look, right? It's much more about a relationship. So we tend to tell our entrepreneurs in our program, we see them. In the beginning of the program, we introduce them to investors that we think are a good match. And they start the conversation with their laptop out and their slides ready. And they start going through the slides and nothing will turn off an investor more. Because it shows a lack of, like, you're not realizing, you're thinking that somehow the slides are going to tell the story that makes them invest, where really, like, they want to understand who you are. They want to see a connection, build a relationship. Like, these things are hard to figure out, and over time, I think you can get better at them. But it's a pretty key point.
Questions? Yeah.
On this subject of discussion, we've been discussing in our group ideas for how to pitch on Friday, and we found that sometimes we're getting caught up in the technical stuff. My opinion is actually we only really need to know 60-70%, I mean, especially at the time scale we've got, we only really need to know 60-70% of the stuff. The rest is ideas and also assumptions that we can break down some of the barriers that are in our way. So this is kind of a specific question. But would you say actually you need to kind of draw a line in the sand and move on and get the idea out there and kind of market it almost rather than worrying about the technical stuff?
Well, I don't have the technical background that these guys have. I am perfectly comfortable throwing super crappy ideas out there, getting feedback, then iterating it, then iterating it, and iterating it. As long as the first couple people you talk to, it doesn't really matter if they have a low opinion of what you said. And then you kind of work yourself up to, well, this person's opinion really does matter. So I'm totally comfortable with that. Other people are less comfortable, but I don't know.
Well, that's why you always come to me with the early ideas.
Come on. No, they've been processed a little bit before.
No, but I think it sort of depends on what your business depends upon, right? And I guess I had double depends in there. But it's interesting because you can't always precisely solve these things. And like if you go through the reverse LinkedIn that I was just talking about, it's imprecise, right? That's what it's kind of annoying because it's imprecise. But that's the numbers game, and you just keep swinging until you hit something, and then you push for that. And so what I'd say is, you have a certain time, you just have a certain allocation of time, and get the best you can. You allocate a certain amount towards the technical DD or the technical maturation. You allocate a certain time to the business and putting together the metric. I'd put together milestones of what you want to achieve, and then a certain amount of time maybe describing the team and what their qualifications are, and maybe a couple other things. And you allocate your time in whatever meetings you have, or maybe over separate meetings. That's how you allocate your time. The former CTO of Adobe, and now he's the guy who does Apple Watch at Apple. He has this really interesting thing. He looks at his calendar. He puts everything he can into his calendar, and at the end of every month, he goes through it. And at the beginning of the month, he says, "This is what I want to accomplish this month, or maybe this quarter." But and then he looks at his calendar and he looks at the actual amount of time that he spent. And if it never matches, but he wants it to roughly match what his goals are for that quarter, like how much time he wants to spend on things, how much time he should be allocating. And if it's different, either his goals are wrong or he's spending his time incorrectly. So I would just you don't have to be exactly precise, but 50% of your time on this, 20% on this, 10% on these two other things. and a little bit of slop time.
I might get, just to add in here, so it turns out, like, as an entrepreneur, being effective at pitching, is, because pitching, right, pitching is broadly, you meet me on the bus, you happen to find out that I do something that's relevant, like, you're immediately pitching in some way, right? Your effectiveness of that is actually a pretty big component to how successful you'll be. So you really want to develop a framework for thinking about how to do that effectively. And, the questions you need to ask up front is, who's my audience, right? Who am I pitching to, right? What am I trying to get out of this interaction? And what are they trying to get out of this interaction, right? So what does a win look like for them in general, right? So I can speak to that. What does a win look like for me? And who is it? So I guess my question, let's just dissect this in real time. So you're talking about the pitch at the end of this program. So is this sort of a simulation? You're pitching to a group of investors, or is it, who are you actually pitching to?
Rachel?
Yeah, that's right.
Rachel's busy, she can't help you. Another thing that happens as an entrepreneur.
I think we define who we're pitching to. We sort of tell them who they are. I mean, they're all real people with actual real investment money, I think.
One of them is Sebastian Lewis from the last panel, and then who was that?
Right, yeah, so the 5 judges that they're pitching to are Ray Rothbach, venture capitalist, Shannon Yee, professor at Georgia Tech, Sebastian Muniz from Cybertown Road, Irfan Ali, nuclear consultant, and who am I saying?
Lindsay Miller. She works for an energy startup.
No, I think the question was we know who they are in real world, but because obviously we're pitching to them, are we telling them what they should be? Because obviously some people are going to have quite specific things. You're saying look for investment. And
What's the pitch? What are you pitching?
Well,
You're just pitching that you have a great idea.
yeah, but I think you can probably go more specific. Like,
Yeah,
say I'm pitching to
he's
you,
asking me
you
right
don't-
now. He's asking me.
Okay,
right
so
now.
we're doing hydrogen production from nucleus, so we want to be pitching to people who are interested in that. That's
But-
what I'm saying.
But yeah, so what is your pitch? What do you want to get out of the audience? I want to
Someone
take.
help.
Well, so I mean, let's think
Yeah,
about
I
it.
can
Just
give you an answer,
based
I
on
can give you an
based on the group of people there, I can imagine that your pitch is: we've got a great idea, and we want to convince the government that they should invest 10 times more in this idea. That could be one pitch. Or the pitch could be: we've got a great idea, and we want to start a company, and this is going to be a pitch about raising money to start that company. So my colleague Sebastian's in the audience. It could be: hey, we've got a great idea. We want to get into Cyclotron Road. This is a pitch on why we could get into Cyclotron Road. Unless you have that defined, you're not going to be able to do it.
One additional
Yeah.
thought is that 90% of the people that you'll end up pitching to won't know why, 50% won't know why hydrogen's important, and 90% will come in with a bias against nuclear. And so you're going to have to be able to pitch it at the super highest level. Like hydrogen, it's used in refineries. It's really important. Oil and gas. You really need to be able to get all the way into details of, yes, we're going to crack water, and here's how it works, and here's why the math, the economics work. So you're going to have to be able to read the audience, know who they are ahead of time, and then be able to talk to them at both the 50,000 foot level and the 5 foot level.
Yeah, and I wouldn't assume, even if you know the people you're presenting to, super smart, maybe well versed in that industry or the technology. Everybody you talk to, usually who's deploying money, is their bandwidth limited. Meaning they may not have had time to do as much research as you might have liked them to do. Maybe they just need a little refresher because they did it, but they did it last night, and then their son got up in the middle of the night, and da-da-da. I'm not speaking from experience, but maybe I am. No, but that happens. And so a lot of times what you need to do is you need to sort of bring people into your context fairly quickly, not violently, but you know that the first couple sentences, if anybody's at all interested in that area, they kind of already know it. But you're bringing them into your context, and you're sort of gently leading them to a seat so that now they're comfortable. You're about to present your idea, why this is different, what my milestones are, what the technology differences are, etc. But here's some overall context to kind of get us all on the same page. Because otherwise, if you jump right into why your business is awesome, you're kind of in sell mode, and really what you want to be is in information conveyance mode. Like here, I'm explaining what I think is a really interesting context, and here's what we can do that's interesting here. One other thing that I wanted to mention, when you're meeting people as well, is remember you're asking advice. Always ask for advice. I would. The money will come if the money comes. Nobody's going to convince. If anybody starts pushing me for money, that's like an immediate like. I don't want to waste time with you. My job is to learn. I can invest money, right? I don't want to say it's easy, but I mean it's much easier to to wire funds than it is to understand an idea. So don't ask me for money. Ask me why you're convince me that you're trying to build an awesome business. Ask me good questions. How do I become a better CEO? How do I understand the regulatory environment better? Who should I meet? What kind of people should I hire on my team? What's a good, who's compatible? Should I hire people? What does diversity look like on my team, and how will that help? Right? Like all these are great questions about building the company. And if you're asking those questions, then people go, you know what? I want to be part of that. And then you can start talking about what your ask is, or what money what resources you need.
So we're pretty much out of time. Any one final question out there? Yes?
Maybe mine's too specific.
Go ahead. That's fine.
So, if our company wants to, or if my group wants to pitch a product that has low investment, low risk for the first stage, but that would be basically a platform that establishes increasing returns on increasing cost steps up from the product, is that something that would be interesting, or is that kind of boring and inverted?
Well, can you be specific? Is this the simulation idea?
No. Okay, so this is it was mentioned before, I think, Fitbit kind of thing.
Mm-hmm.
Basically, it's a data infrastructure for, it doesn't necessarily have to be even nuclear, but a power plant or some kind of facility that doesn't necessarily have good connection between the personnel.
The Fitbit for energy facilities idea.
Yeah, and so you start out by instrumenting personnel, then you go up to instrumenting equipment, and et cetera.
So it's like a mobile device you walk around and.
Yeah, I mean, I think to generally, I mean, it seems interesting to me, right? But to generally answer your question, right, this is why who the audience is and what they want is important. So at the highest level, right, the reason I was saying, are you pitching to an investor to raise money, right? If that's the case, right, what they want to understand is how are they going to make money?
Yeah.
Right? How are you
What
gonna
problem
create
are you
value?
solving with this cool data collection device?
Yeah, if you're pitching to the government to say we need to invest $100 million more in hydrogen, in this particular approach to hydrogen fusion, then what do they want? What do they care about? They care about solving that problem. There's sort of a social economics, so that's what you're pitching to. Now, I think your question gets into okay, we're pitching for investment. Then it's a question of are we pitching the right strategy for how they're going to make money? And that's the next sort of subclass of, there are certain investors that, only want to invest if you can immediately make them billions of dollars, right? It's going to be hard to know. I think in this context,
Yeah, I don't think it's a turnoff for
Yeah.
everybody. There are definitely people that invest there. And again, you can kind of pick your funds. You can go look and see what people have invested in initial, sort of small seed, but where they're doing a lot of hypothesis testing, they get through it. And then, but knowing that in the strategy, these milestones, 4, 5, 6, or maybe 7, 8, 9, those are expensive. But the reason that they're willing to invest and have in the past in these other sort of hardware or capital intensive businesses, the reason they invested is because they proved out the market prior to this. And in fact, the electric car charging one that I was talking about, we're in the middle of raising a fairly large Series B. And there's sort of two questions about it. Should we raise a large Series B and we've identified people who've done capital intensive raises before, or should we do a little bit more modeling and a little bit more software and kind of prove out the model and then raise an even bigger chunk to really just blast out the hardware all over the place? And it's an interesting, I don't know what the answer is. Sometimes you just have to choose, make a bet, right? And so you make the best bet you can. And if you don't know how to make the bet, defer it.
Well, on that note, I don't know what the agenda is now, but this panel is concluded. Peter and Alon, thank you guys for